Ladies and gentlemen, our next speaker is Mr. Rick Rule, who doesn't need any introduction, but I have few words to say about him. He's one of the most humble, generous libertarians I have ever met. He's also very witty and gives you his undivided attention when you talk to him. Today, he's going to share with us how our erroneous and irrational beliefs and emotions lead us to a self-destructive path, and how his value system is the way to create an abundance mentality, generate wealth, and become a successful individual. With great honor, I would like to invite Mr. Rick Rule at the podium to share his wisdom with us.
Thank you, Rajni. It's with some trepidation I tackle a topic as big as the one that you just assigned me. I didn't realize I was going to say all those things. I was last week at a gathering. The introduction reminds me. I was last week at a gathering. I won't mention the gathering, but truly a gathering of the enemy. Really powerful group, and they invited Henry Kissinger to speak. And they call them sires at this place. The people who run the seminars within this big gathering introduced Dr. Kissinger by saying, "Our next speaker needs no introduction. He's ubiquitous. He's spoken here 18 of the last 20 years, blah, 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 blah. You know, may I give you Henry Kissinger?" And Kissinger stumbled up to the stage and said, "Although it is true, perhaps, that I don't require an introduction, there is no one who has ever spoken here who enjoys a generous introduction more than I." Anyway, I'm not going to talk too much about philosophy because I'm not a philosopher, and I'm not going to talk too much about economics because I'm not an economist. I'm a speculator, and I'm going to talk about speculation, and I'm going to talk about your response to society and your response to the state, and how, although many of you, probably all of you, are or would describe yourself as libertarians and anarcho-capitalists, your buy-in to collectivism reduces your own investment performance. This talk came about as a consequence of a very non-libertarian talk I gave at a very non-libertarian meeting, an investment conference that Giant was at, and it was a talk I gave on investment risk. And during this particular conference, there were a whole bunch of speakers. In fact, all the speakers. It was a sort of, one of these gold bug doom and gloom, God, guns, and gold gatherings. And there was a whole discussion of of risks, various types of risks. There were interest rate risks and market risks and cyclical risks and this risk and that risk. And what I wanted to point out to people was that the worst risks that they faced, probably as humans, but certainly as investors or speculators, were very, very, very conveniently located immediately to the left of the right ear and to the right of the left ear. And that in fact, we are the authors of most of our investment misfortune. That isn't to say that the factors that surround us, the external factors that surround us, don't present risks, sometimes fatal risks. But I would argue that those risks are uncontrollable. And the only thing that we can control, in fact, the only thing that determines realistically whether we're going to be successful or unsuccessful in investing, probably in other aspects of life, but I'm not qualified to comment on those other aspects of life, are our own responses to the risks that come from the outside. I guess what I'm trying to say is that at least in my life, in every realm of my life, but certainly in speculation and investments, my worst wounds were all self-inflicted. And one of the interesting things that I observe among investors and speculators, the community that I know best, including you, libertarian or anarcho-capitalist investors or speculators, is despite the fact that we know and mouth discussions of self-reliance and distrust in the state, many of us misunderstand the nature of the risks and the nature of the protections that are offered up. And as a consequence of not taking responsibility ourselves for responding to these risks, our behaviors are suboptimal, our performance is suboptimal. Let's talk about a few of them. One of my favorites is, of course, political risk. And for those of you who don't know, I'm in the natural resources business. I'm involved in speculating and occasionally investing, seldom these days, but mostly speculating, in businesses like mining, oil and gas, forestry, agriculture. And these are businesses that are particularly susceptible to political risk. Those of you who are smart enough to be in businesses that are less capital intensive, those of you who are involved in intellectual property businesses, if you suffer the depredation of a society and a state, even if I owned a ship, something mobile, an asset that was mobile, if you run into some problems with your own society, you leave, you go somewhere else. It's very, very, very difficult not very difficult, but it's much more difficult for the collective to steal from you than it is for the collective to steal from me. Mines, if you're fortunate enough to find them, are very stable, and hence politicians love them. They're wonderful targets. There's no better target than a mine. You put $2 or $3 billion into it, it's stuck, it's there, it's fixed, it's visible, and they grab it, they tax it. What's interesting about our response to political risk, all of our response to political risk, is despite the fact that all of us, to some degree, believe that all governments are evil, that the most efficient governments are the most evil, when it comes to assessing political risk, forget this. Specifically, political risk is a risk that we seem to respond to emotionally rather than rationally, meaning that political risk for us is still driven, not by our understanding of the state, but rather by what we see on television. In the mining business right now, the political risk that's evident, where could we say? Malawi, Argentina, places like this. Places where the experience of political risk has been most recent are judged by us to be the most extreme because we feel. In fact, when Mrs. Kirchner nationalized or stole YPF, the response to that was that small cap companies invested in Argentina fell by 75%. I would argue with you that those companies almost instantaneously became 75% less risky. Political risk, in one sense, is a function of the price that you pay to experience it or avoid it. And when people look at the political risks offered up by Argentina, when they respond to their feelings, as opposed to thinking through things, they expose themselves to much more political risk. Let me give you an example. I have an Argentine client and friend, wealthy Argentine, and I was inquiring of him after the nationalization of YPF, what he felt the risks associated with mining projects in Argentina under development was. And his response to me was very illustrative, and it's something that all of us should listen to. He said, Mrs. Kirchner stole YPF because she wanted to steal $1 billion a month to fund politically expedient domestic spending programs. The idea that she would steal a deposit that she had to spend $3 billion on before she could steal the cash flow is nonsensical. So the political risk associated with Mrs. Kirchner in the context of her understanding of her own self-interest would lead you to think that the political risk in Argentina, perhaps after the event, was less than it was before, but that wasn't the price expectation. The other thing that I think is interesting about political risk, especially when I hear this objection from libertarians and anarcho-capitalists, is that political risk in third world nations, political risk in frontier nations, and in particular, political risk in non-white nations is less extreme than political risk here. It's as though our community believes that money that is stolen from you in English by Caucasians, according to the rule of law, is somehow less gone than money that's stolen from you. It's interesting, and by the way, I'm not entirely immune to this over my life. I immediately react negatively to situations I don't understand as well. But what I have learned in 30 years of practicing speculation in natural resource businesses around the world, and I'm not making a joke of this, the worst personal experience that I, Rick Rule, have had with political risk came in a jurisdiction that I knew very well. It occurred in the People's Republic of California. In that jurisdiction, I was part of discovery of a deposit called the Castle Mountain Discovery by a company called Viceroy Resources. We discovered this deposit, fair and square, according to all the rules, made by and provided for. Most of the deposit, in fact, was on deeded fee land. Some of it was, in fact, on state land. And despite the fact that we had an absolute legal right to build this mine, the political process kept us from being able to build this mine for 12 years. The free cash flow associated with that mine at the gold price that existed at the time that we made the discovery was worth about $700 million. My math isn't good enough to tell you what the net present value of losing access to $700 million at a 10% discount over 13 years is. But I suspect that those of us who were shareholders and discovered that mine lost the sunny side of $500 million. And people suggest to me that the Congo is risky. In addition to the fact that we didn't have access to the cash flow during that period of time, we had to pay $16 million in bribes. These weren't the efficient kind of bribes that you might pay in the Congo, where you got payment for services rendered. My old friend Adolphe Lundin once said his definition of an honest politician was a son of a bitch who stayed bribed. A little harsh, perhaps, but accurate. These were very different types of bribes. These were contributions of property in lieu, campaign contributions, some truly farcical stuff. I mean, some stuff I actually got value for over time. I didn't realize I'd get value for them. But as an example, there was a critter there, or there was alleged to be a critter there at least, a desert tortoise. Everybody here sort of familiar with desert tortoises? They're little reptiles, sort of like Volkswagen Beetles. Nice things. And of course, I don't think the environmentalists actually cared about these tortoises. They were a tool to use on us. But that notwithstanding, that was part of the rule of law. And so we had to send out these herpetologists, nice guys, by the way, to look for tortoises. And these were young, hardworking, diligent herpetologists. But despite the fact that they had all these attributes, they couldn't find any tortoises. Well, that wasn't good enough. The response came that tortoises were sometimes subterranean. So we couldn't look for these tortoises on the ground because they might be underground, and given that we were going to mine underground, we could hurt them there. Okay. So we got some other herpetologists, and by the way, they tried to fabricate a motorized skateboard to go in these burrows with a camera. I mean, some really, truly bizarre things happened. They're fun to talk about, but they were very expensive. Anyway, they couldn't find any tortoises there either. But that wasn't the end of it. The fact that they couldn't find any tortoises, but that this was known tortoise territory, meant that tortoises might be able later to walk into the mine site and get hurt by these big trucks. No doubt, by the way, that they would get hurt if they got hit by a big truck. So, the political solution that we agreed on, and this is where I got my money's worth, actually, because I'd be able to tell stories like this for the next 20 years. The political solution that was forced on us, that the powers that be on our side had the good sense to accept. I was outraged, but at least it got done. The political solution that we agreed on is that we surrounded the whole mine site with a tortoise fence. About up to here. Now, those of you who don't know about tortoises will just have to take it on faith that these things don't climb well. They don't fly for shit, right? They're these little things. What they do reasonably well is burrow, as they had pointed out to us before, because they wanted us to look in burrows. There was no requirement that we bury any of this fence. The second critter issue that we faced was something called, I'm not making this up, by the way, On my honor as a stockbroker, this is all true. There was another critter there called a Mexican mine bat. And this Mexican mine bat, well, they're not endangered exactly, there's just not very many of them. And the reason that there aren't very many of them in California is because there's no good terrain for them. They like caves. And the Southern California deserts don't have any caves, except old mine shafts. And so prior mining activity on this property had left mine shafts, and these bats had colonized these mine shafts. Now, heaven forbid that mining disturb critters. By the way, foreign critters, alien critters, weeds, critters that were encroaching on territory as a consequence of human intervention. But anyway, heaven forbid that these critters be disturbed. So we had to hire these other guys, and nice guys, by the way. These people in these agencies are invariably nice people. They really are. Batologists, or I don't know what they call these people, but they're people who do bats. And so the idea was that we had to get these bats out of harm's way. And bats are pretty shifty. They do better in the dark than we do. So moving these bats was a real challenge. And it ended up that we put these mist nets out, and people clapped their hands, and the bats got all freaked out, flew into the mist nets. We gathered them all up, and we took them to other shafts, 17 or 18 miles away, put them in those shafts, and then at night, they do what you expect. They came home. And so this cycle went on a couple times, and the batologist said to us, listen, this is really disturbing the bats. And we suspect that when construction activities commence, that the bats will leave. And we said, could you put that in writing? Could you put that in writing? And yes, I'm telling this story to amuse you, but I'm also telling you this story to illustrate the fact that political risk is greatest from the government that touches you the most. How many people here live in British Columbia? A lot of you. So I was addressing an investment conference yesterday and the day before, talking about political risk. And we were talking about various places that scared Canadians, in particular, of course, recently, Argentina. How many people lived in the province of British Columbia the last time the NDP got elected? Fair number of you. Do you remember that as a good time for mining? Anybody here remember that as a good time for mining? Let's go one province to the east. The sort of bastion of free enterprise, Alberta. Do you remember the last time natural gas prices rose? 5-6 years ago? The response of the provincial governments, the conservatives, the free enterprise people, was to just about double the gas royalty, causing us to call it Albertistan. Now, despite that, I'm supposed to be concerned about political risk in places like Congo or Russia or Kazakhstan. So one of the things that I'd like to leave you with in the context of this is that it isn't so much political risk that you need to be worried about in your investments. It's your own method of interpreting what political risk is and the price that you pay to either accept or insure yourself against political risk. It's funny that it stands to reason, but people don't employ the test on themselves. I'm going to make some general discussions about our attitude towards money and things like that later, but I want to continue on this vein for a little while because I think it's important. There's other people here who are much better at describing for you the philosophical and ethical aspects of today's discussion. I want to go right straight to your greed and larceny so that I know I can keep your attention. Another interesting thing that happens, and it happens more among non-libertarian communities than libertarian communities, but there is this sense in the securities business, in the investment business, that the government protects you, that this whole apparatus of the state, the whole regulatory regime surrounding the investment business serves some useful purpose. What people do, I suspect, when they call up me and they ask me to act as a broker or a money manager, is they're willing to exchange fees in order for me to take responsibility for something they should take responsibility for, which is their own wealth. And if they can get that for free, if they can cause the government to do it, as opposed to paying me to do it, so much the better. There is a conception out there on many people's parts, including many libertarians, that as a consequence of regulation, that the investment business or the investment process is safer. And I would argue to you that exactly the opposite is true. The presence of the regulation, and particularly the fact that people like you and others rely on the protection of the regulator, makes you much less wary. The best steward of your wealth, including in an interaction with somebody like me, who you at least should trust and respect, the best steward of your wealth is you. And anything at all that detracts from you exercising your own intelligence, your own prejudice, your own work in defending your own capital is counterproductive. Now, it's come to the point where those agencies are especially counterproductive as a consequence of their institutional response to their own failings. My friend Doug Casey may have stolen this phrase from somewhere else, but 20 years ago, in a speech he gave, he referred to the big regulator in our country, the Securities and Exchange Commission, the SEC, as the Swindler's Encouragement Committee. There was a point in time when I just thought this was one of Doug's clever turns of phrases. But what I've come to learn personally, being regulated by the SEC, is that people like myself, who are in fact ethical and, when we understand the law, law-abiding, are easy targets. The will-o-wisp, the charlatan, the fraud, the people who are always on the move, the people who are dodgy, they're very tough targets. What regulator would want a tough target? Why don't you go after somebody who is well capitalized, who is a fixed target? And as a consequence, the efforts of the regulators are usually on what they perceive to be fixed, soft targets, not exactly the community that they were set up to go after. I had a visit, I do every 2 years, with the, I gotta say it correctly, the Securities and Exchange Commission, the SEC. And it's an interesting process. They come in and you get an entrance interview and you get an exit interview. And in the entrance interview, and the same thing happens, by the way, with the self-regulatory authority, the FINRA. In these interviews before the audit, you are allowed to tell them things about your business that you think they ought to know, that might help them with their audit. And at the end of the audit, you can question them about their results and about their practices. And they're very, very, very useful. It used to be 20 years ago that I avoided those entrance and exit interviews just because I was allergic to those people. But what I've learned is they are just people, and it's very, very, very useful. So in the entrance interview, I have taken to saying to the auditors, you know, one of the things that you need to know about our firm is we're required to have this much net capital, and we have this much net capital. That says two things for you, Mr. Regulator. In the first instance, it says to you that I'm not afraid of investor rescission suits. I'm not afraid of my own malfeasance. Otherwise, I would have stripped the cash out of my firm. The second thing it says to you is if I do go upside down, there's enough cash in there that it won't harm the industry particularly. That's very useful because what they're really looking for is not to make a mistake which would negatively influence their career. That's what they're really looking for. But a couple of years ago, I had more interesting things on my mind. And a regulator, by the way, very, very, very nice young guy comes in and we're talking. And I said, listen, I want to make sure I have this right. And so you got to help me. An audit, in an audit of a securities firm, what you do is you look at my trade blotter. That's where you recognize every transaction that you did. And you look for evidence of the transactions by taking trade tickets. Maybe you take 20 or 30 of them, and you call the counterparties to make sure the trades happened. On the other hand, you take the check registers. You see the payment that you received for the sales that you made, the checks that you wrote for the purchases that you made. And that's the basis of the audit. And of course, immediately the guy says, oh, well, no, we checked this and this and this and this. Right. I know you do all that. But really what you do is you want to make sure that we did what we said we were going to do, right? And he says, okay, right. I said, okay, here's my question. You guys, because you're supposed to check all of us once every 2 years, had to do 8 audits on Bernie Madoff. 8 times you had to check his trade blotter. You had to pull his trade tickets, and you had to check his check register, and you had to call those guys for the counterparties. And he didn't make any trades. So I'm not a securities regulator. I mean, I'm a credit analyst. I'm a Shylock. I could have busted him. How is it that he got through 8 audits with you, he never made a trade, and you pulled and called trade records, and you pulled and called checks? How did that work? What kind of audit was that? Response was interesting. Mr. Rule, the Los Angeles Bureau has been curious about that too. True story. True story. This is the protection that you're offered up. The response, of course, to this failing by the SEC and by FINRA was the suggestion that they were overworked and needed a larger budget. The fact that somehow they attended to 8 audits, or they didn't, only one or the other can be true. I mean, they either went there or they didn't go there. Those are the only 2 choices. Neither of them good. Because his was a much bigger firm than mine. If they managed to come see me, they should have managed to go see him. He was certain, I mean, Madoff was certainly more important than Rule, especially the aftermath, would suggest that the suggestion that this agency offers up protection from fraud is in fact fraud. Another thing I'd like to leave with you is Enron. Enron was a situation where for years they were a registrant. For years they filed a plethora of reporting documents, probably this high. I mean, I don't know how high they were, but there was lots of them. And they were filed according to the rules made for and provided by in statute for years and years and years and years and years. It turns out, arguably, that they perpetrated fraud. As a consequence of that fraud, and by the way, anybody here, you're a lawyer, right? Was fraud illegal before Enron? Before it happened? That's what I thought. I mean, I wasn't sure, I'm not a lawyer, but I sort of remember, you know, the dim, distant recesses of my memory that fraud was already illegal. As a consequence of this failing by the regulator, by the protector, to catch the fraud perpetrated by Enron, what did Congress do? They increased the SEC's budget, and they passed something called Sarbanes-Oxley. Now we're going to get into the economics of protection. The judge in the Enron case estimated in sentencing that the Enron fraud cost American investors $70 billion. That noted libertarian, social conservative, Warren Buffett, has estimated that Sarbanes-Oxley costs American shareholders $100 billion a year. So a regulatory failing, not a market failing, a regulatory failing that costs taxpayers $70 billion a year has been institutionalized into a set of absolutely useless regulations that will not, by the way, protect anybody from fraud, that costs us $100 billion annually. Yet, when I come to gatherings, even gatherings like these, there are people who believe that they don't need to read the regulatory filings themselves as a consequence of the fact that there are lots of regulators in an over-regulated business that will protect them. In fact, you do need to read the filings, and you need to read them knowing full well that there are a lot of people out there who will lie in the filings. You yourself need to assume that there will be another Madoff, that there will be another Enron. I don't need to name the malcreants here in town. You're familiar with them. You know them. They exist in a regulatory environment, and the population of miscreants and malcreants in this regulated environment, this city, are legend. And the notion that the British Columbia Securities Commission or the Ontario Securities Commission, the Toronto Stock Exchange, the Securities and Exchange Commission, or any of these other people are going to do anything that would cause you to discharge your own personal responsibility to understand, first of all, the person you invest with, if it's somebody like me, or the company, is complete nonsense, and yet we do it. On a bigger scale, and this will be, I guess, a little bit philosophical, it was touched on by Steph, and I thought it was brilliant. The immorality of suggesting to society at large that they are protected by the SEC or by Social Security or by any of this system that would appear to anybody who didn't flunk third grade math that they're going to go broke it's crazy. I talk to so many investors who believe the promises that have been made in the context of the SEC, in the context of Social Security, I run into a whole different class of investors who, as a consequence of government action since the 2008 psychotic break in credit markets, believe that the political response to that crisis in terms of the government participation in the economy was in the first instance desirable and in the second instance sustainable. And I want to talk about that response, and I want to talk about that response in the context of what you do with your money now. Does anybody in the room believe, for yourself, that any of the causes precedent to the 2008 market collapse, does anybody here believe that they've been addressed in any way, shape, or form? By the way, you can raise your hand if you want to argue with me. I'm just curious if anybody in the room believes that the set of circumstances that gave rise to the 2008 collapse has been addressed. Nobody, right? What they did, from their point of view, was pretty intelligent. People were terrified, and so there was a credit contraction. The big banks, each individually, knew that they were broke. And they knew, as a consequence of the fact that they were broke, that their counterparties were broke. And so there was no interbank lending. There was no short-term credit. So there was no credit to hedge funds. There was no credit to companies. There was no credit in the commodities chain. And what the government did was, in the context of how they live, the right thing to do. They flooded the market with liquidity. They told the banks, yes, you're broke, but you won't be, right? Yes, you have a solvency issue, but we'll screw them all. We'll put liquidity in. You guys won't go broke. And that's where we are now. The continued response that we're seeing now, that the crisis is, from their point of view, over, is very interesting. They are continuing to provide liquidity. They're doing this really for, I think, 3 reasons. The first reason is that they genuinely are confusing a solvency issue with a liquidity issue. The root problems of 2008 didn't have anything to do with liquidity. That was an event that was caused by a solvency issue. What we figured out as a society is that lending people 125% of the value of a house that they couldn't afford was not a good investment. I mean, that was what it was all about. And all these guys recognized that they'd do it, so none of them would loan money to each other. It wasn't about liquidity to begin with. But they are dealing with the problem on a continued basis with liquidity when the issue is, in fact, solvency. Does anybody in this room believe that in a society like the United States, where the on-balance sheet liabilities of the federal government are $16 trillion, the off-balance sheet liabilities of the government are, pick a number, $70 trillion? Let's call it $85 trillion in total liability. Does anybody believe that this gets better by adding $3 trillion a year in debt? That's what the response is. The second part of the response is maybe more troubling. The second reason, I think, for adding all this liquidity to the system is securities fraud. These guys couldn't sell their bonds any other way. And that's what's happening in Europe, by the way, right now. What's happening in Europe is actually pretty clever. Depositors, rational human beings, are taking their money out of the banks, and the governments are substituting credit lines to the banks, unsecured credit lines from governments to banks. And the banks are using these credit lines to buy sovereign bonds. It's really very clever, really very clever. Besides which, if a bank in Europe makes a loan to a living, breathing person or an entity, they have to reserve against that loan for the probability of default. But if they make a loan to a sovereign, irrespective of the creditworthiness of the sovereign or the term of the loan, they carry that loan on their books at full value. So a German bank that owns a Greek bond where there's no possibility of repayment over 70 years, over 30 years, pardon me, that's trading at 60% of par, gets carried on the bank's books at par. The same thing happens in this country. I'm sorry, I'm in the wrong country. The same thing happens in that country. In that country, the US federal government takes between 50 and 60% in a year by way of taxes of what they spend. There's 40% left over. They raise about half of what's left over, between 20 and 25% of the federal government, federal budget, by convincing people often foreign, about half foreign, to buy US government bonds. But they can't sell all the bonds that they print. So they do something very clever. They have these open market operations under the guise of adding liquidity. In fact, these guys are buying their own paper. There's a word for that, a very precise word for that in English. It's counterfeiting. It isn't counterfeiting, apparently, when it's done by Caucasian people in English, according to the rule of law. It's only counterfeiting if we do it. You know, if it was such a good idea, they ought to let us do it. But they won't let us do it. The third thing that I think they're doing, and this is probably the most pernicious, is that by adding this liquidity, they're forestalling a market clearing event, and they're inspiring confidence. And I have Doug Casey to thank for this, too. Doug Casey said, with regards to currency, the root word of confidence is con. And this is a true con. I mean, this is a true con. Think through this. Doug gave a conference a couple months ago where David Stockman was there. I'm not suggesting that David Stockman is a good libertarian, but neither is he anymore a battered old Republican warhorse. What David Stockman taught us is that the total federal government debt is about $85 trillion, growing, as he said, by $3 trillion a year. He said that the surplus debt service capability of the American public is in the range of $500 billion. Now, what I'd like you to do is I'd like you to write two numbers down right now. 85 trillion, that's 85 if you don't know it, followed by 12 zeros. It's a bunch of zeros. You have to have a big piece of paper to do this. And then what I want you to do is I want you to write down $500 billion. That's 500 with 9 zeros. And so that you don't have to be an economist, so you can be like me, just a credit analyst, Shylock, a speculator, is scrape 9 zeros off each number. The proposition is that this is a household with $85,000 in debt and $500 a year in income to service the debt. This is not a pretty outcome. And what happens as a consequence of this this liquidity that's added in the system, is that people think that the system is functioning. And it is functioning. The lights come on, the SEC has their budget, everything goes on as normal. But planning your life around the fact that it's going to continue to go on requires you to believe that you can add a big column of negative numbers and come up with a positive. I would argue with you that the function of government in this circumstance is in fact to cause you to believe that you can add a column of negative numbers to get a positive number. We might argue about the utility of a market clearing event. Everybody here know what market clearing events are? I mean, one of the beautiful things about the old Vancouver Stock Exchange is that about once every 10 years, the exchange would fall by 95%. You know, you'd have these little BS mining companies that were selling for $2 a share, and at the end of the exercise, they were selling close to their intrinsic value, let's say a dime. And that did a wonderful thing. It exposed these companies to their true value, and it also eliminated in a temporary but efficient fashion the specter of moral hazard. And it's moral hazard, if you will, it's Enron, that we encourage with this officially sanctioned money printing, with this fraud, with the protection that's offered up by the SEC. One of the reasons that the United States and Canada and other countries have for so many years done so well in economic development, in things like that, has been competition. I was asked the other day at the conference here in Vancouver, the Agora conference, why the export of shale technology, shale gas technology and oil technology hadn't happened, why the exploitation of energy shales in North America was so much more vibrant and so much more vital than it was in other parts of the world. Simple answer, the technology can be exported, but what can't be exported is here in these countries as a consequence of the residual freedoms that we still enjoy, is that a problem, a technical problem, let's say in the Barnett Shale, is tackled by 40 companies or 50 companies or 60 companies. People make horrific mistakes. They drill dry holes, They have blowouts, they make all kinds of mistakes, they try technologies that fail and cost their shareholders $20 million, and occasionally they succeed. And the service providers, if you will, the intellectual connective tissue in the oil and gas business, understands over time the best practices and the worst practices, and they accumulate the best practices, they get rid of the worst practices, and over time, in this very messy process called a market, you figure out how to do something right. You optimize the process. In other parts of the world, oil and gas exploration is carried on by national oil companies. In other words, by the post office. You have a monolith that tries to employ technology, and there aren't 40 or 50 competing partners trying something and failing. They only consistently fail. There's no new ideas. The second part of our success in North America is a consequence of the fact that we have, at least in the oil and gas business, some form of the rule of law with regards to subsurface mineral rights. There's some sense that if you drill a well and make a well, and oil and gas comes back and you sell it, that you get to keep some of it. That doesn't happen so well in other jurisdictions. It's interesting to me that the lessons that we should have learned in the context of our success employing technology in the energy business fail us when we look at other aspects of human behavior. The idea that we would give the government a monopoly on the oversight, as an example, of investments in securities, when these same monopolies have been shown to fail in other spheres of human endeavor, makes no sense to me. Why wouldn't we as a society, well, never mind. Why wouldn't we as individuals feel better about a system in securities regulations that was voluntary, insurance-based, publishing-based? Why wouldn't we favor a situation where we subscribe to investment newsletters that had been successful at doing due diligence, as opposed to trusting a multi-billion-dollar bureaucracy that keeps yielding Madoffs and Enrons? It's a mystery to me. It's a total mystery to me. Where do I want to go with this? I want to talk about two other things that are much less focused on speculation. These are actually probably topics that I don't need to dwell on in this room, but they're certainly topics that I had to propose and defend pretty vigorously the last 3 days at the other conference across town. And again, I'm in some debt to Doug Casey for teaching me these lessons. There is a tendency, I think, for some of us who have gotten rich to apologize for it. There is a tendency for people, as an example, currently, to avoid being described as a member of the 1%. Now, the fact that the 1% walks around with a target on their back makes some forms of self-identification a fairly stupid thing to do. But the idea that people who have achieved have something to apologize for seems to me to be very strange. In my experience, and there are certainly exceptions, in my experience, the accumulation of wealth has been a function for most people of producing more benefit for others than they consume themselves. You sell something to someone in a win-win fashion that they value more than you do. Otherwise, a trade wouldn't take place. The act of acquiring income is a function of generating utility for others. And if you produce more utility than you consume, you get wealthy. Everybody with me so far? So, if this is true, then isn't getting rich generous? Isn't getting rich in and of itself evidence of generosity? By the way, I'm not suggesting that all of the wealth that was accumulated in the world was accumulated in a generous fashion. Certainly Mr. Madoff couldn't be described as generous. Certainly Lay and the fellows from Enron couldn't be described as being generous, although they were extremely charitable. Different name, different word. But I would argue, and I would argue that you should argue, that in most cases, the act of becoming wealthy is evidence of generosity. It's evidence of a contribution in and of itself. There is a suggestion that the rich as a class have to give back. My argument is it's a privilege to give back if that's something that you want to do, but the fact that you're rich demonstrates that you have already given. And if you are really rich, it's evidence that you've given a lot. Thank you. I'm going to, well, I got to say, now I'm part of a public company now, so I am part of a small government in one sense, but assuming that my board of directors gives me approval, in my own office, I'm going to pass out T-shirts identifying some of the staff as members of the 1%, and I'm going to pass out other T-shirts to some of the other younger members of the crew that say Aspire. I hope I'm allowed to do that. Well, maybe I'll ask for forgiveness as opposed to permission. I'd like to follow this on a little bit in terms of challenging, probably not perceptions in this room, but perceptions outside the room, with regards to philanthropy. And that is this: I think the most philanthropic thing that an achieving person can do is build their business. The idea, and this is not a criticism of Bill Gates, by the way, because I think he's in many ways a spectacular person, but the idea that he is going to contribute more good to the world by giving away $20 billion or $30 billion, as opposed to the good that he could do if he drove Microsoft even harder and turned out more software and more applications, is farcical. Farcical. The amount of good that has been done by the Bill Gateses of the world. My business couldn't exist without Microsoft. It literally could not exist without Microsoft. The securities business as a whole could not exist without Microsoft. And I'm not suggesting that he owes society an obligation to keep people like me in business. I am simply saying that the amount of good that he could do by focusing himself on growing Microsoft as opposed to passing out mosquito nets, very, very, very dubious proposition. It's his money. If he wants to pass out mosquito nets, God bless. But I suspect that what he is doing, how would you say, from a mathematical point of view, from a performance point of view, is anything but philanthropic. Anything but philanthropic. I think that the most important thing that business people can do in terms of philanthropy is building their business. Now, I'm philanthropic. There's some stuff that I want to see done that I can't do, and I haven't been able to pay anybody to do it in a profit-making fashion. I would prefer to do that. You know, I'd prefer to invest in a company that was going to find some way to solve some social ill that I perceive, and I'd prefer to pay them to succeed as opposed to subsidize them to try. But that hasn't been made available to me yet, so I give away some money. But I don't feel, personally, any obligation to do this as a consequence of the fact that I've been successful in some other realm. And I think the sense that society has that people who have been successful owe some obligation is silly. It's really silly. Finally, and I want to tie this back a little bit to the earlier part of this talk. In terms of your own money, I believe, I'm not an economist, I'm not a philosopher, I believe that the current set of situations that we're in the West, Canada and the United States, will resolve themselves in one way or another. And the fact that the liquidity that washes through the system makes us all feel like everything is under control is a very, very, very dangerous illusion. Now, those of you who know me well, and I have a lot of clients here, know that I have many failings as an investment analyst, but my principal failing is that I personally am a very, very, very linear thinker. I believe if this is true, and this is true, and this is true, and this is true, and this is true, that the logical outcome is this, and I confuse two words, inevitable and imminent. And I can't tell you when the fact that we're trying to service $85 trillion in debt on $500 billion a year in income has an unhappy ending. I can only tell you that with the limited amount of mathematics that I possess, that it's going to happen. And I would ask you to look after yourself. I would ask you to think about the fact that while this may not be imminent, it is inevitable. And planning your life as though the SEC and the IRS and SSI and the Department of Defense and the Department of Energy are somehow going to shield you from this inevitable reckoning is a real mistake. I think that failure to recognize where we're heading, not organize your whole life around it, but certainly recognize it as a contingency, means that you don't take into account the fact that I started the lecture with, which is the greatest investment risk that you face isn't your government, it's your response to your government. It's to the left of your right ear, to the right of your left ear. I hope you all take account of the facts that are in front of you, and I hope you all make the decisions that are appropriate to you. And I'd like to thank Jayant and Rajni for the opportunity to address you and the opportunity to listen. Thank you very much.
We have time for a couple of questions.
How do you think that the 700 to $1 quadrillion worth of derivatives out there is going to affect this liquidity and cause the banks to quote unquote fail? My voice will carry throughout the world.
Most of you heard the question, but I'll paraphrase it to make sure that I answer it correctly. The gentleman asked how the derivatives, which is a generic term for strange securities, CDOs, yeah, how that will impact liquidity on the banks. The answer is I don't know. I don't think anybody knows. What they do is they add another layer of leverage on an already insanely over-leveraged system. Buffett describes a situation where two young rocket scientists design a customized 15-year-long mutual obligation, and both of them book a profit for bonus purposes in the quarter they originate the transaction. That's not the way a trade works. I mean, it's supposed to be mutually profitable, but these are unpriced securities. There was a popular phrase on Wall Street 10 years ago. They don't dare say it anymore, but there was a popular phrase among Wall Street operatives 10 years ago. Went like this: I won't be here, you won't be here. What is here is federal deposit insurance and all of the mechanisms of preventing the fraud from being exposed and preventing people like you and I from acting rationally to protect ourselves from it. The idea that, I won't name the names, but that some of the big banks would have $35 trillion in notional value of derivatives on their books, and that they are trying to be a funded intermediary with $20 billion in equity is farcical. The argument that they propose is that these are hedged obligations, that they don't have a $35 trillion net exposure. Trillion's a big word, by the way. I mean, it's a lot of zeros. What they're arguing is that their net exposure is half of that. I feel better. The thing that they neglect to mention is that if a counterparty can't pay, the flip side of that obligation, which they're hedged on, becomes valueless, becomes absolutely valueless. It's their balance sheet that's the balance sheet of last resort. And to the extent that if you add back in these derivatives, these banks have an equity slice of well less than 1%. I'm not trying to say that this is what would bring the banking system down, but I know for sure I'm not smart enough to run a balance sheet with 1/2 of 1 cent in equity against $1 in variably performing asset obligations. What you learn very early on in business school, and then very thoroughly in business, is that your assets are ephemeral, but your liabilities are always money good. Does that help? Jayant, kick me off when I'm done. Okay.
Hello, my name is Robert David. I have a question about LIBOR. I'm not sure if it's within your realm of expertise, but I find it curiously absent in the mainstream media, the coverage of this.
The LIBOR manipulation.
LIBOR rate rigging scandal, yet it's just the 16 largest banks in the world caught rigging interest rates among one another. what is the, I'm really trying to understand the relevance of this event more than anything. It seems to be
The gentleman
huge.
mentions that a large number of international banks, I guess beginning with Barclays, either solely or sometimes as a cabal, manipulated the most important lending rate in the world, the London interbank rate. And they allegedly did this so that they could make money speculating in bonds. By controlling the LIBOR rate, they controlled the prices of the bonds, which were based off LIBOR. The consequences of this, of course, to holders of derivatives and other interest rate sensitive instruments are incredible. The regulators are sort of in an interesting set of circumstances. They're trying to keep the banks afloat, and they are at the same time set upon convicting them of a crime that has a $600 or $700 billion minimal implication. The thing that interests me about the whole scandal is that the financial press, and in fact the mainstream press, are absolutely outraged about the bank's manipulation of interest rates, and they don't say anything about the manipulation of interest rates by the central bank. The idea that the US government, as an example, can drive down our rates, in other words, can declare war on savers, and there's no suggestion that that's a manipulation. There's an income transfer in the United States, a private income transfer of $400 billion a year from people who work through their lives and save through their retirement, and they don't get the interest that they deserve as a consequence of government manipulation of the interest rate. And yet there's this enormous hue and cry about people who we already knew were gangsters manipulating LIBOR. I'm not excusing the LIBOR manipulation. You know, it's what you would expect it to be. I wouldn't say it was sanctioned by the regulators, but certainly the banks have been kept afloat since 2008 by the regulators. So to say that they weren't indirectly complicit for not shooting these guys in the ear 4 years ago. Do you remember 4 years ago? Well, these guys cost all this money, billions and billions and billions of dollars. And then their boards of directors said, we got to pay these guys big bonuses or they'll leave. I mean, if I was running one of those banks, that's not a discussion we would have had. You know, why? Anyway, I go on a tangent.
Last question.
Okay, I just wanted to ask you about Vancouver real estate because, well, you're here and it seems like we've got this huge bubble in real estate and real estate drives this entire economy or a very, very big part of it. And we just keep hearing the bubble's going to burst, something's going to give, and the CMHC and the cheap money, it's always there. So I just wanted to reconcile this, or just get a few of your comments on how far can we keep going on this route.
I'm part of the problem. My wife and I own a condo here, which we love. And we realize it's selling for probably 3 times what it's worth based on the rent that we could receive for it, and it's not for sale. One of the problems that Vancouver has from an economic point of view is it's drop dead gorgeous, so people want to live here. I suspect that part of the real estate bubble in Canada, in Vancouver at least, well, in Canada generally, has to do with subsidized mortgages, you know, a socialized interest rate. And I think some of it has to do with flight capital from China. I have a couple of well-connected Chinese clients who do business in China because they know how to do business in China, but export their kids to Canada, just in case. I don't know this to be the case, by the way. You know, I'm a resource guy, and I'm a credit analyst, not a real estate analyst. But when I first lived in Vancouver in the 1970s, I used to buy duplexes and triplexes in the east end of Vancouver. And my rule of thumb is that I would pay 100 times the monthly rent for a house on the theory that I could paint it up a little bit, increase the rents by 8% a year, and come out over time. You know, I looked at a house as a bond. When the baby boomers came through the situation, there was this incredible demographic bulge that came through and drove demand for housing. People began to think of real estate as an asset that couldn't go down in price. So I think there's a residual attraction to real estate from people looking at the fact that it worked as an investment for 30 years and maybe not understanding why it worked for 30 years. I think there's a suggestion, a an accurate suggestion that the costs of owning real estate are artificially low as a consequence of the interest rates. And I suspect that part of the demand in real estate in Vancouver is a consequence of flight capital from Asia. But I want to caveat all that by saying I don't have an awful lot of faith in my expertise in real estate. So it was free information. Probably I charged you more than it was worth. Ladies and gentlemen, I'm done. Thank you very much.
Thank you, Mr. Rick. It was great to have you at the podium, as always. We now have a coffee break for 15 minutes. 15 minutes, and then we will start our discussion again with our next speaker.